Bitcoin has been a polarizing topic in the financial world, with enthusiasts touting its potential as a revolutionary asset and skeptics dismissing it as a speculative hype. Yet a recent event with, has sparked a fresh wave of discussion. Strategy, a business intelligence firm turned Bitcoin advocate, purchased $2 billion worth of Bitcoin without noticeably pushing its prices higher. To many, this might seem counterintuitive. Shouldn't a massive buy like that send Bitcoin's price soaring? According to Bitcoin educator Forrest Heil, this lack of price movement is not only a good thing but a critical sign that Bitcoin is maturing into an asset capable of attracting the world's largest investors. Today we'll explore why this event matters, what it reveals about Bitcoin's liquidity, and how it could set stage for the significant price growth in the future. To understand why strategies purchase is significant, we first need to grasp the concept of liquidity. In simple terms, liquidity refers to how easily an asset can be bought or sold without affecting the market price. A highly liquid market allows large transactions to occur smoothly with minimal impact on price stability. Think of it like a busy highway. Cars can enter and exit without causing a traffic jam. In contrast, an illiquid market is like narrow dirt road. Is any significant activity clogs up the space, leading to wild price swings. For Bitcoin, a 2 trillion asset as of 2025, liquidity is a make or break factor for its adoption by institutional investors. These big money players, hedge funds, mutual funds, pension funds, and asset managers manage trillions of dollars and need assurances that they can enter and exit position without getting stuck. Imagine a crowded movie theater with only one exit. If problem arises, everyone rushing for the door creates chaos. Similarly, if an institution invests heavily in an illiquid asset and then needs to sell it, whether to take profits, cut losses, or rebalance, low liquidity would trap them, forcing them to sell at unfavorable prices or crash the market entirely. Microsoft's recent 2 billion Bitcoin acquisition, led by an outspoken CEO Michael Saylor, serves as a real world test for Bitcoin's liquidity. The company has been aggressively accumulating Bitcoin for years, treating it as a corporate treasury asset. For instance, firm brought roughly $1.9 billion worth of Bitcoin in a single week, an enormous sum by most standards. Yet Bitcoin's price didn't skyrocket at the same time some might expect. Instead, it continued its usual fluctuations, with no dramatic spike tied directly to the purchases. To, this is a bullish sign. Why? Because it shows Bitcoin's market has enough depth to absorb large capital inflows without destabilizing. In trading terms, this reflects a narrow bid ask spread, the difference between what buyers are willing to pay and what sellers demand. A tight demand indicates a healthy balance of buyers and sellers, allowing big traders to execute a fair market trades. For comparison, liquidity markets like small cap stocks or certain options, where a large order can create wide gap between bids and asks, driving prices up or down unpredictably. Bitcoin's ability to handle strategies by suggests it's moving beyond that stage. The real significance of this event lies in its implications for financial adoption. Major financial players, think BlackRock, Citadel, or CalPairs, don't mess around with small volatile markets. They need assets with scale and stability. Now let's highlight a few examples. JP Morgan's asset management division oversees $3 trillion, while global bond market exceeds 130 trillion. Even a modest 1% allocation from these giants, say 30 billion from JP Morgan, dwarfs MicroStrategy's 2 billion buy. For Bitcoin to attract such capital, it must prove it can handle these inflows without breaking. Institutions also prioritize risk management. They want to enter positions knowing they can exit quickly and efficiently, especially during market stress. Now let's see at S&P 500, a 40 trillion market which can absorb 50 billion investment from CalPairs. without a pension fund owing a disproportionate share or moving the needle too much. Similarly, the $25 trillion US Treasury market offers unmatched liquidity for bond investors. Bitcoin, with its 2 trillion market cap, is small but growing. Strategies purchase suggest it's already liquid enough for some buyers, though others may wait for further expansion. To put Bitcoin's liquidity into context, let's contrast it with alternative investment like private equity valued at 4.5 trillion in 2023. While larger than Bitcoin, private equity is less liquid, often requiring lockup periods to manage trades. Bitcoin, by contrast, trades 24/7 globally with no restrictions, a double-edged sword. Its unrestricted nature demands a naturally deep market to avoid volatility, which strategies by demonstrate is emerging. Meanwhile, smaller cryptocurrencies beyond Bitcoins remains even less liquid, making them less appealing to big money. Now let's look at general threshold institutions use. They prefer positions to be less than 1 to 2% of an asset's daily trading volume or market cap to avoid price impact. For a $1 billion position that requires 50 to 100 billion in volume, a level Bitcoin's actively trading community increases supports. This high volume, driven by retail and institutional interest alike, bolsters its liquidity profile. For Bitcoin enthusiasts who are about numbers go up, the argument is clear. Liquidity is the gateway to institutional capital, and institutional capital is the fuel for significant price growth. If Bitcoin can handle $2 billion today without blinking, it's inching towards absorbing 20 billion or 50 billion tomorrow. As more players like BlackRock, Larry Fink take notice, the cumulative effect could push Bitcoin's price to new high. Beyond price, the Bitcoiner's broader mission of financial freedom, a widely adopted Bitcoin strengthens his case for a decentralized store of value, less reliant on any single entity like MicroStrategy to prop up. The market resilience to such buys proves it's not just sailor's plaything. It's a global asset with staying powers. Strategies to build in Bitcoin purchase may not have sparked a price frenzy, but that's precisely why it's exciting. It reveals a market maturing in liquidity and depth, relying itself for big leagues. As institutions seek alternatives to equities and bonds, Bitcoin's ability to absorb large trades without chaos positions it as a contender. For those dreaming of higher prices, this is a stepping stone, a sign that highway is widening and big cars are starting to roll in. Whether you are in the freedom or profit, Bitcoin's journey is the one to watch.